Depreciation. In a previous module, we looked at some components of the initial outlay which may be capitalized. This means that the cost of equipment and some other initial development costs may be capitalized. They are not claimed as a tax deduction at the beginning of the project, but instead the cost is apportioned over the life of the asset or the project, and then they are subject to depreciation. In this module, we'll look more closely at depreciation and its effect on cash flows. We'll start with a definition of the term depreciation. It means apportioning the cost of a capital asset over the useful working life of the asset. It's primarily an accounting function. It's designed to match revenue and expenses in a given period of time. The important thing to remember is that depreciation is not a cash flow. It is never included as an incremental cash flow in the calculation of NPV. However, the payment of tax is a cash flow. We therefore need to understand depreciation in order to understand the depreciation tax shield. This means a reduction in tax payable as a result of depreciation. Paying less tax than we otherwise would is an incremental cash inflow, because the reduction of tax is an amount that the firm is better off. Before we continue, we'll look at some terminology that we need to understand. The depreciation itself is the annual reduction in the value of an asset, which is claimed as a tax-deductible expense. Accumulated depreciation is the total depreciation up to this point in time since the asset was purchased. And the book value at any point in time is the cost of the asset less the accumulated depreciation up to that point. There are two main depreciation methods: straight line and diminishing value. Under straight line depreciation, the cost of the asset is depreciated uniformly over the life of the asset or the project. In other words, the same amount of depreciation is claimed as a tax deduction every year. Diminishing value is what's called an accelerated form of depreciation. The depreciation each year is a fixed percentage of the asset's book value at the beginning of that year. Sometimes instead of the term straight line depreciation, the term prime cost is used. Diminishing value is also sometimes called reducing balance, which means the same thing. Looking firstly at straight line depreciation, the annual amount of depreciation is generally the cost of the asset divided by its working life. The only exception to this is if tax law imposes some other constraint on the amount of depreciation that can be claimed per year. It is rational to claim as much depreciation per year as possible. So if the tax law allows you to claim more than the amount of depreciation indicated by this calculation, we would do so. This is in order to reflect the time value of money. The earlier we receive a cash flow, the more valuable it is to us. And as we said earlier, the depreciation tax shield, the reduction in tax payable as a result of depreciation, is an incremental cash inflow, and we want them as early as possible. A machine costs $8,000 to purchase and install and has a useful working life of 5 years. It will be depreciated on a straight line basis to a book value of 0. We need to calculate the annual depreciation amount, the accumulated depreciation after 3 years, and the book value after 3 years. The annual depreciation amount is the cost of the asset, $8,000, divided by its working life, 5 years. So we'll claim $1,600 a year as depreciation. The accumulated depreciation after 3 years is just 3 times $1,600, or $4,800. And the book value after 3 years is the initial cost, $8,000, minus the accumulated depreciation at that point, which gives us a book value of $3,200. We'll turn now to the second depreciation method, diminishing value. Under this method, the depreciation each year is a fixed percentage of the asset's book value at the beginning of that year. To calculate the amount of depreciation in any year, we multiply the depreciation rate by the book value of the asset at the beginning of that year. The depreciation rate is usually equal to 2 divided by the life of the asset in years. For example, for a 10-year project, the depreciation rate would be 2 divided by 10, or 20%. The difference between the two depreciation methods is that diminishing value results in more depreciation earlier in the life of the asset, and therefore less depreciation later in its life. Because of the time value of money, this makes diminishing value a preferable method to use. So if a company has a free choice between depreciation methods, it would be rational to use the diminishing value method. Once again, we have a machine costing $8,000 to purchase and install, and which has a useful working life of 5 years. It will be depreciated on a diminishing value basis to a book value of 0. We need to calculate the depreciation rate, the depreciation amount in the first year, and the book value at the end of that first year. The depreciation rate is 2 divided by the life of the asset in years, which is 5, giving us a depreciation rate of 40%. The depreciation amount in the first year is 40% times the book value at the beginning of that year, or $8,000, giving us depreciation of $3,200. And the book value at the end of the year is the book value at the beginning of the year, $8,000, minus the depreciation in that year, $3,200, giving us a book value of $4,800. In order to calculate the amount of depreciation each year under diminishing value, we can set up a table like this. The book value at the beginning of year 1 is the cost of the machine, $8,000, and as we've established, the depreciation in the first year is $3,200, giving us a book value at the end of the first year, and therefore at the start of the second year, of $4,800. The depreciation in the second year is 40% of $4,800, or $1,920, giving us a book value of $2,880. The depreciation in the third year, 40% of $2,880, which is $1,152, and so on. 40% of $1,728 is $691, giving us a book value at the beginning of the fifth year of $1,037. If we continue calculating depreciation in this way, we would have depreciation of $415 in the last year and an ending book value of $622. However, at the beginning of this example, we were told that we depreciate down to a book value of 0, and therefore if that's the case, we would normally depreciate all of the remaining book value of the asset in the fifth year to give us a book value of 0. As was mentioned earlier, the purpose of depreciation is to spread the cost of an asset over its useful working life in order to match revenue and expenses for accounting purposes. However, since depreciation is not a cash flow, we don't include it in the calculation of NPV. We include the initial cost of the machine when it actually occurs, at the beginning of the project. A fundamental principle behind Australia's tax law is that all costs associated with earning revenue are tax deductible. And we find that if we add up these values, the total amount of depreciation is $8,000. The $8,000 cost of the machine has all been claimed as a tax deduction, but through depreciation rather than claiming a tax deduction at the beginning of the project. We can compare this table with a similar table for straight line depreciation. Instead of these amounts occurring per year, the depreciation is $1,600 per year. But at the end of the day, the book value of the machine is 0 and the total amount of depreciation is $8,000. The important difference is that under diminishing value we have more depreciation earlier in the life of the asset and less later in the life of the asset, and we would rather this on the basis of the principle of the time value of money.